Today we're here to talk about inheritance tax and how we can help you protect your assets for the future generation. I'm Kat and I'm joined by my colleagues Vicky and Sarah. So what are we going to cover off today? Essentially, what is inheritance tax? What key exemptions could apply to reduce the inheritance tax? What the budget changes were that came in October last year? And what planning we could do to help you mitigate your inheritance tax.
So what is inheritance tax? Inheritance tax is a tax that we pay sometimes on death and occasionally on lifetime. Currently, we don't pay inheritance tax on the first £325,000 of our assets. That's a lifetime and a death transfer exemption. We also have a residence nil rate bound, 175,000. This is available when you leave your home to a direct lineal descendant. The figures there, the 325 and the 175, are quite specific. They add up to £500,000. They're transferable, and that was the magic £1 million nil rate band that was talked about a few years ago, that the government at the time wanted to give us £1 million of exemption from inheritance tax. It's a 40% tax on death and on what we call pets and CLTs. I'm not going to talk about those, Vicky is. If we have to pay inheritance tax in our lifetime, it's at 20%. And these thresholds have been frozen up until April 2030, we've been told. We do have some exemptions. So in lifetime, if we want to make a gift, £3,000 gift is free of inheritance tax. If we didn't use that exemption in a current year or last year, we can actually combine those to do 6,000, and that's per individual. So a couple can give away up to 12,000. Some other exempt gifts in lifetime and in death are gifts to charities, community amateur sports clubs, which can be a popular one to support a local sports club, political parties, and gifts for national purposes. We can also have a small gift exemption, £250. That's again a lifetime gift, and you can do as many £250 so per grandchild. Sometimes people use that one at Christmas. We can also have gifts when somebody is getting married. So again, this is a lifetime gift. So if your child is getting married, that's a £5,000, that's per parent. If your grandchild is getting married, it's £2,500. If you are getting married, you can give the person you're getting married to £2,500. And anybody else, if you're making a gift on marriage, for example, a godparent, it's £1,000. Important to remember, if for any reason, sadly, that marriage didn't take place, that exemption would therefore no longer be available. And finally, regular gifts out of surplus income are a really powerful inheritance tax planning tool that Kat's going to talk about.
So when we say regular gifts out of income, what do we mean? Essentially, what we'd look at is your total income for the year, so the gross income that you've received, and from that we deduct off your tax liability, plus any other living expenditure that you incur normally, so mortgage costs, gas and electric, food shopping, holidays. Any of your normal expenditure needs to come off that figure, and if there's a surplus at the end, then you can gift that away, and it's immediately outside of your estate for inheritance tax, so it wouldn't be considered a pet as long as you meet HMRC's conditions. So those are that it's regular. And when we say regular, it doesn't have to be monthly, it doesn't have to be weekly, it needs to be annually. So you need to make sure you're hitting that gift every year. And equally, it's got to be out of your surplus income. So we need to be able to demonstrate that your living style has not been denuded by making this gift. So we can help you keep a record of that, because you would need to make sure you keep good records for your executor, so they're aware that this is out of surplus income and not a pet. And we can help you with those forms to make sure we document it every year for you.
So looking at potential exempt transfers, these are lifetime gifts to usually individuals, so it'll be your children, grandchildren, and what have you. If you survive 7 years after the date of that gift, that falls out of your estate completely. If unfortunately you don't survive the 7 years, there is some form of relief in the form of taper, but that only applies to any gift over and above the current nil rate band of 325. So obviously, say for instance, you made a £500,000 gift, £125,000 of that would potentially be subject to taper if you died within 7 years. As was already mentioned, the potential exempt transfer is, if that fails within that 7-year period, the charge would come to fruition on the donee, so the person to whom the gift has been made. Chargeable lifetime transfers, this is the very specific situation where lifetime transfers are made to something other than an individual. So the normal scenario there would be to a trust. And in these circumstances, there is a lifetime tax at 20% if and only if you go above the 325 exemption. On death, if you don't survive the 7 years, then you have a 40% charge, but you do credit that 20% that has already been paid during your lifetime. And there are still availability of taper relief against that death charge.
So, what were the key budget changes last October? As you'll probably all be aware from the news and everything that you've seen out there with farmers especially, from April 2026, business relief and agricultural relief is being restricted to £1 million. So essentially now the value of those assets, as long as they meet the conditions, are free from inheritance tax, and they have been for a number of years. From April 2026, they're going to be restricted to £1 million at 100% relief. So that's that first million will be exempt for inheritance tax. Anything over and above that, they're going to receive a 50% relief. So effectively, the value above £1 million is going to be taxed at 20%. AIM-listed shares, they will not qualify for that £1 million. They will receive the 50% relief. So effectively, their value at the point of death is going to be charged at 20%. And then from April 2027, pensions are going to be subject to inheritance tax.
So Kat mentioned the reliefs of business relief and agricultural relief. So let's understand what those reliefs are a little bit more. Business relief is available on your shares in your unquoted company. It's available on your value if you run as a sole trader or your share of a partnership. Agricultural relief is available, as it says really, on agricultural assets. So land used for farming activities, either growing crops or raising animals, the buildings used in a farm, and the farmhouse subject to size limits are usually qualify for this relief. Again, as Kat mentioned, that at the moment that's whole relief. We get the whole value is completely free of inheritance tax. Sometimes business relief is only at 50%, but that's pretty rare. From April 26, we've got this £1 million, and then everything above that £1 million only gets 50%. The really, really significant difference with this relief and some of the other reliefs we've got in inheritance tax is at the moment we believe this isn't going to be transferable. So in a situation where normally people leave their estate immediately to their spouse, potentially because a spouse wouldn't pay any inheritance tax, that band could be wasted. And so I think what we'll be looking at is people changing their wills to make sure they don't waste that first £1 million.
So the pension changes are next. So currently, pensions receive 100% relief from inheritance tax. And then depending on how old you are when you pass away, will depend on whether there's any income tax to pay or not. So if you passed away before the age of 75, your pension can be inherited tax-free. So your loved ones can then draw that pension without being subject to income tax. From age 75 years or over, then there'll still be inheritance tax-free currently, but your loved ones, your beneficiaries, would pay income tax then to draw that pension. So the changes are, from April 2027, is inherited pensions are going to form part of your estate and be subject to inheritance tax. Now, where you've got your nominated beneficiaries as your spouse and that asset's transferred, then potentially you'd still benefit from spousal exemption on the first death. So we might only be looking at this on second death. However, this is going to have a significant impact. So if we look over here at an example, if we've got a pension worth £500,000 in this example, and assuming that you're age 75 once you've passed away and your estate already takes you over all of the thresholds, this is what the tax position essentially is going to be. Inheritance tax at 40%, so already that's a £200,000 charge. That's an increase from £0 to £200,000. That immediately reduces the value of that pension down to £300,000. And then if your loved ones draw that pension, let's say they draw it as a lump sum in 1 year and they're a high rate taxpayer, potentially the tax could be £120,000. So we're leaving a pension pot at £500,000 that effectively is reducing down to £180,000. That is a massive change. Equally, if your loved one was to draw a smaller amount every year, so treat it as an income, then it might be that they'd be subject to basic rate tax, so only pay tax at 20%, but essentially they will have already suffered that inheritance tax. Now, there was a consultation period that happened when the government made these changes, and that ended in January, and that was to discuss and discover the way in which that inheritance tax was going to be paid. So could it be paid directly by the pension provider to HMRC rather than your loved ones having to find the cash to pay it? So we're still waiting for the final legislation to come out on all of these changes, but at the moment it's still going to have a significant impact from how we know it.
So taking some further examples, just going back to obviously the two changes in April 26 and April 27, the current situation of this particular estate here, we're looking at obviously on the second death, where on the first death everything is moved to the surviving spouse. We have a total estate of 3.45 million, made up of the main home of 500,000, business assets of 2.2, cash and other assets of 150, which just to bear in mind that that's quite a small amount of cash available, pensions of 600,000. Here we get business relief in full on the 2.2 million. Pensions don't fall into the estate at all, so that's deducted out. A nil rate band of 650 takes this estate down to zero, so nothing to pay. We don't talk about the residence nil rate band in this scenario because the estate value is over 2.7 million, and at that point the residence nil rate band is fully tapered down. So go on a year, and what we have then is the main home obviously still there, unquoted shares, cash, pensions, total assets still 3.45 million, but we have a change in the way that the reliefs are structured. So we have the business relief at 100%, as was already mentioned, on the first million, but after that we only get 50% relief, so that brings 600,000 effectively into charge. At 600,000 at 40%, we've got £240,000 worth of inheritance tax. So on a death on the 5th of April 26, zero inheritance tax. Death on the 6th of April, 240,000. Moving forward a further 12 months, and the pensions also come into play, so they also form part of the death estate for inheritance tax purposes. This obviously, combined with the reduced business relief, gives a taxable estate of 1.2 million, and we're therefore looking at a £480,000 tax charge. So we've gone from 0 to 240 to 480 in the space of 2 years.
And obviously that's going to have a massive impact to people, because if we look on this scenario, we haven't got the cash there to be able to pay the inheritance tax. So we're going to have to do something with the assets to raise those funds. Equally, you could possibly look at electing to pay the inheritance tax over a number of years. So there could be a way of staging those payments, but you know, we want to try and get this figure as low as possible. That is the plan.
Yeah, the lifetime planning there is the important thing, I think, at this stage.
So moving on to planning, when we look at planning, it might be that when we've got business assets, so we might have shares in a limited company, we might look at passing on those assets sooner rather than holding on to them on death. So if we look at farmers, for example, it was always the case that a farmer would die with his boots on, because essentially he's never had to worry about the inheritance tax and passing on that business. It's always been free of inheritance tax. However, now we might need to pass that on sooner so we can try and mitigate some of that exposure. Now, obviously, there can be tax charge on gifts in lifetime. With certain business assets that qualify, we can actually claim holdover elections, so we can reduce that CGT to nil effectively. That will obviously take some careful planning to make sure that we don't fall foul of any taxes, but it's something that could be looked at.
A really, really important thing to do is review your will, and more important, if you haven't got a will, make your will, because the rules of intestacy are very specific and not really able to be changed, whereas if you've got a will, you can do things like deeds of family variation within 2 years. So it's really, really important to get a will. It's important to review your will, and if you want us to get involved in reviewing a will and seeing how inheritance tax efficient that will is, we're happy to do so.
The next one, the most powerful tool, is to spend your money. So not spending it on other assets that are going to increase your estate value, but spending your money, you know, go on that holiday. Somebody once told me, so I won't take the credit for it, if you look at when you are spending your money, everything's coming with a 40% discount. because effectively, if your loved ones inherit that money and then go out and spend it, it's cost them 40% more potentially. So definitely we'll look at spending your money. Gifting assets.
So obviously Kat mentioned about giving away businesses. We can give away other things. Of course, there may be some capital gains tax depending on the asset. And referring back to when Vicky spoke earlier about pets, if you give something away and don't survive that gift for 7 years, it could be a pet. But again, starting to look at gifting assets during your lifetime could be a way of reducing that overall estate.
Yeah, and bringing into trust, obviously, I talked about the chargeable lifetime transfer, so there are implications of obviously gifting to a trust. However, there are nil rate bands available during your lifetime that obviously you can use for obviously gifting into a trust without an immediate tax charge. Obviously, sometimes the decision is made to have that smaller tax charge earlier in order to avoid a later tax charge on death. Trusts also are a very special beast as far as holdover release are concerned for capital gains tax. So where we have assets that are not business assets and therefore the normal forms of holdover are not available, such as maybe rental properties, that kind of thing, these can be moved into a trust with a holdover election. So that is quite an important planning tool.
I think trusts are good for people who like to keep control as well, aren't they, Vicky?
Yeah, definitely.
Give an element of control, which a normal gift doesn't give you.
Yeah.
Charitable donations, obviously Sarah talked about these in the exemptions, so they are exempt for inheritance tax, but equally if you give away 10% of the net value of your estate, it reduces the rate of inheritance tax that you would pay, so from 40% down to 36%. And Sarah actually had an example where this saved the beneficiaries some money.
So the interesting thing with a charitable donation is, as I talked about deed of variation, you can actually vary a will and increase that if you want to hit that magic number that Kat's talked about. In the case that we're talking about here, by increasing that gift to the charity, because the overall IHT rate reduced, everybody who was receiving gifts from what we call the residue actually got more money than they would have got if we hadn't made the charitable gift. So the charity got more and the recipients got more. The only person who didn't get more was the taxman.
Which is essentially what we want.
And I think I'll interject here as well, because there is a very important thing with charitable gifts, because you have three elements of an estate potentially. One is your free estate, which is basically everything that's subject to your will. You have a settled property where you may be a beneficiary already of a trust that falls within your estate. And you also have jointly owned assets, which potentially fall to people by survivorship. Those latter two, you don't have any control over what you do with those, so they are basically divested in different ways, whereas your will you are very much in control of. So that is where you could actually make a bigger charitable donation via your will, and that will allow those other two parts of your estate to obtain the 36% tax charge instead of the 40% as well. So very, very useful tool.
Absolutely, Vicky, that's a great point.
And then the last thing we want to talk about is insurance. So I think if we look back to the example, obviously we saw that potentially there was a big inheritance tax bill and not necessarily free cash to pay. You can take out insurance that pays on death, and as long as that's what we call written into trust, it doesn't form part of your estate and will give your beneficiaries an asset to pay. Equally, when Vicky spoke about the pets and the fact that they fall back to be charged on the person who received them, so if you're the recipient of a significant gift, you may want to look at some form of insurance just in case within 7 years you've got some inheritance tax to pay.
And that's a term assurance, isn't it, that one?
Yeah, obviously you'll need to take financial advice on that, but they can help you with what the insurance policy would be, ensure that it's written into trust and that it's beneficial to you and would pay out potentially the right amount on death or a significant amount. So in summary, what do we want you to take away from this? Well, essentially, we want you to make sure that your will is up to date and that you indeed have a will in place. That is the most important. Quantify the value of your estate. So what are we looking at? What is the current exposure and what can we plan to reduce that? Equally, we might need to plan your income extraction. So if you do have a business that you're taking income from and you need to continue so, obviously we wouldn't suggest giving all of your shares away because we need to make sure you can still draw that income. So we would help plan what that extraction is going to be. Then we would calculate your potential inheritance tax exposure, so you know potentially what inheritance tax you may have to pay. And essentially then we're going to review and see what planning we can do to help reduce this down and mitigate it as low as possible. So Obviously, you may have a few quick questions. Feel free to fire those over to us on email. Our contact details are on screen, info@twca.co.uk. However, what we are offering is the chance for you to come book in a meeting with us. And from that meeting, we can review your current will, review what your assets are going to be, and then from there decide if there's any planning that can be done. Equally, if there's any planning that you need to do. Those meetings are £300 plus VAT for the initial meeting starting from. So please feel free to get in touch and book your meeting today. We'd love to hear from you and we'd love to be able to help you.